what political configuration in DC mean for your portfolio?
So I'd pick up on Stas's comment about the relationship between stocks and bonds. For 20 years, it was kind of a perfect, like bonds, treasury bonds were sort of a perfect asset class from about 2002 up until essentially January 3rd of 2022, if you had a bond portfolio at that time, because they had a negative correlation with stocks. So if stocks sold off, bonds rallied, so that diversified your portfolio. They had a good return because starting yields back in 2000 were around 6%, and they had relatively low volatility. So today, starting yields a little bit lower, but still not bad, all things considered, compared to where we were. Volatility still and should be relatively contained, but this correlation, I think that's probably not going to go back to what it was before. And in simple terms, I think in an environment where the markets are more worried about growth, and for the 2010s at least, you're more worried about slipping into recession, the correlation tends to be negative. When you're more worried about inflation, and I think that's going to be the risk going forward, that inflation can be contained, but the risks are always skewed to a little inflation shocks, that correlation is not going to be as negative, it may be positive. So from portfolio construction and asset allocation, then you have to think about, well, if bonds aren't going to diversify my portfolio, I have to think about other asset classes. And so privates are, I think, kind of front and center, whether it's hedge fund strategies, private equity, private credit, infrastructure, real assets that could again provide some return there. So that's definitely one thing that we think about, how do you add and diversify. The second thing, and it actually kind of picks up on a point that you mentioned earlier on, the number of zombie companies. Think of particularly small caps. You hear these statistics out of the Russell 2000 index, 30 or 40% don't make any money. Now, the small cap sector overall, I think, has changed a lot in 25, 30 years. The number of public companies in the US was over 8,000 back in 1995, 96. Now it's less than 4,000. And a big part of that is private equity is kind of taken up a lot. Companies that might have gone public, they're going through the private route. It does kind of raise the question to me, if private equities looked at the Russell 2000 and bought all the good stuff, and if I want to buy it as a public investor, am I getting kind of an adverse, the lemons problem? Which does mean that, and we look at well, now you almost have no choice but as an asset allocator to look to private markets because there are opportunities there that weren't there 10 years ago, certainly 20 or 30 years ago. So thinking about portfolio diversification and thinking about your opportunity set, that is, I think, sort of fundamentally changed versus, even just 5 years ago.